Welcome to this explainer. Today, we are tearing right into Rob Bourgeoisian's explosive third white paper to uncover the actual structural architecture hidden deep inside Wall Street's leveraged ETF ecosystem. Now, if you've ever had that nagging suspicion that the financial game is somehow rigged against the everyday investor, well, you're in the right place, because this research is literally the smoking gun. We're going to break down exactly how these products work under the hood and, far more importantly, how you can leverage Rob's concepts to create trading strategies that drastically outperform the market, all while taking on substantially lower risk.
You know the old saying, right? If you look around the poker table and you can't spot the sucker, it's probably you. So if you hold leveraged or inverse ETFs, what we call LETFs, in a long-term portfolio, you absolutely have to ask yourself this exact question. And honestly, it doesn't even matter if you put them there intentionally or if some manager quietly tucked them into your retirement plan. Are you the mark? Because what Rob's forensic audit reveals is that in this specific, highly engineered market ecosystem, there is always a predetermined winner and always a predetermined loser.
Just let this number sink in for a second. $100 billion. That massive figure is the estimated net issuance profits that have been extracted directly from investors and transferred straight into the pockets of LETF sponsors and their counterparties. Think about that. This isn't money lost because the market had a bad year or the economy took a dip. No, this is a systematic, one-way wealth transfer.
To really grasp what's going on, you have to understand that this decay we see in these funds is not a bug. It is a mathematically required feature. See, because these are synthetic swap-backed instruments, the issuers literally cannot afford to lose money on their daily flows. Academics love to call this compounding loss volatility decay, but let's call it what it is. It's a mechanism engineered to keep the issuers and their counterparties perfectly solvent while slowly bleeding retail and institutional investors completely dry over time.
It's honestly a brilliantly rigged casino. When we analyze just 12 specific ProShares LETFs, we see a perfect zero-sum game. Every single dollar of the $13.8 billion lost by investors in these specific funds was captured exactly by the house. They aren't magically guessing the market direction better than you are. Their products are simply designed so that your structural loss becomes their structural gain. All right, let's get into part one, finding the footprint, and Wall Street's behavioral tell. Wall Street really thought they hid this wealth transfer perfectly behind complex swaps and multi-layered wrappers. But here's the catch. Because issuers must sell shares for more than they redeem just to survive, they inevitably leave behind a glaring operational footprint. They simply can't hide their daily mechanical necessities. And that footprint, it is simply the daily change in shares outstanding. This is entirely public data, guys. Issuers are mechanically forced to create shares right before a price drop, and they have to redeem them right before a rise. They have to do this in aggregate, or they would operate at a massive loss. So what we're looking at isn't some fuzzy market sentiment indicator, it's a strict internal economic necessity. Which brings us to Rob's day-late, dollar-richer strategy, or DLDR. This is a totally transparent, rules-based hack that just mirrors the issuer's moves on a one-day lag. It's incredibly simple. Step 1, you check yesterday's change in shares. Step 2, if they created shares, you short the ETF today at the closing net asset value. Step 3, if they redeem shares, you buy the ETF. That's it. You are quite literally just drafting right behind their forced, profitable behavior. I absolutely love this quote from the paper. The signal isn't a forecast, it's a footprint. You really don't need predictive AI algorithms, moving averages, or some secret insider access. You literally just need yesterday's public flow data to exploit the issuer's mechanical necessities. They leave the breadcrumbs, and we just follow them straight to the bank.
Moving right along to Section 2, Proof in the Profits and Beating the Casino. So what actually happens when you mechanically execute this one-day lag, this T+1 strategy, against Wall Street's own products? What happens when you flip the script and use their structural requirement to win as your own personal trading signal?
Well, you get a staggering $8.85 billion in modeled profits, and that's just across 12 decaying commodity and volatility LETFs. By simply trading one day behind the issuers, this model snatches a massive portion of that wealth transfer right back from the house.
What is truly mind-blowing here is the sheer consistency of the alpha generated. We're talking about a nearly 35% compound annual growth rate over a decade, and you don't even have to use leverage yourself. This strategy doesn't work because it relies on being right about the global economy. It works because it relies on Wall Street honoring its own self-preservation math.
Now, issuers will often use paired funds, like a long and short natural gas fund or long and short volatility, as loss leaders to try and mask their intent. But when you trade both sides using DLDR, it completely exposes the underlying profit machine. The win rates and profit factors here are off the charts. You get massive risk-adjusted returns because you are trading the actual architecture of the game itself, instead of guessing which individual product they're sacrificing today.
Section 3. How anyone can play and scaled access. Now, I know you might be thinking, okay, this sounds great for billionaire hedge funds or high-frequency trading desks, but what about me? Well, the beauty of DLDR is that it scales flawlessly for anyone willing to follow the rules, utilizing end-of-day execution that completely eliminates intraday noise and slippage.
So you can scale this model down perfectly, whether you're a high-net-worth individual or a retail investor. But honestly, let's take some artistic license here, because you can go way beyond Rob's basic framework. Think about alternative strategies using these signals. Let's say the ETF complex suddenly redeems 30, 40, or even 50% of the shares in ZSL, which is a short silver product. That massive redemption means ZSL is highly likely to go up. And if a short silver product goes up, that is a highly credible, mathematically backed signal that silver is about to take an imminent nosedive. So instead of touching the toxic LETF, you could just buy put options on silver futures or short silver directly. You're using Wall Street's own forced footprint to guarantee profits with very little risk, while completely bypassing the ETF decay altogether. It's brilliant.
But of course, we have to ask, does this actually work in real life? To prove this isn't just back-tested theory or hypothetical setups, Rob took the core strategy live on SQQQ. For those who don't know, that's the 3x inverse NASDAQ ETF, and it is easily one of the market's most notorious wealth destroyers.
Operating at that tiny 100,000th retail scale we talked about, the live SQQQ model generated over a 40% return from March to July 2025, completely verifiable by the public. Real-world execution holds up perfectly because, again, issuers do not behave this way by accident. They behave this way because they absolutely have to in order to maintain solvency.
Which brings us to Section 4, exposing the cover-up, and why was this missed? This is honestly the most frustrating part. If it's this incredibly simple to beat the house, and the flow data is completely public, why hasn't the financial industry or the regulators shut it all down? Or why hasn't everyone noticed this yet? The simple answer: intentional obfuscation. Wall Street deliberately buries these decaying products inside multi-layered wrappers, things like collective investment trusts and pooled asset vehicles, where basically zero transparency rules apply. It makes it practically impossible for everyday investors or even their financial advisors to realize they are holding these toxic bleeding assets in their 401ks. And what happens when regulators actually try to trace who is holding these toxic assets by asking for trading records? Well, the tracking infrastructure itself is conveniently broken. Look at the massive fines handed out for defective reporting. When the very system designed to track market abuse is itself abused and broken, it raises a really dark possibility, doesn't it? Maybe these products were never meant to be traceable in the first place.
The ultimate takeaway from all of Rob's research is this: these losses are not accidental side effects of a volatile, unpredictable market. The decay is embedded by design. The issuers are going to profit regardless of what happens to the investor. They are quite literally selling a financial product with a predetermined structural outcome.
So I'll leave you with this to consider today. If you can reliably beat the house using a one-day delayed, incredibly simple public model based purely on their own operational footprints, are the smartest quants on Wall Street just bad at their jobs, or is the game rigged? Now that we actually possess the forensic key to track their footprint and the knowledge to build alternative high-leverage strategies right off their signals, will you remain the patsy at the table, or will you start using their own data against them?